companies have a problem in that the interests of their workers or shareholders might have the same problem with the management of a company, in that their interests aren't aligned with the owners of the capital or of the firm itself, the managers of the firm. And we call this a principal agent problem or an agency problem. And the issue is, how do you align the interests of the agents with that of the principal? So we think of a worker who can either shirk or put in higher effort. And with higher effort, of course, the profits of the company go up. But there's always the incentive for me as an individual to want to shirk. It's in my interest to take it easy or relax or even steal from a company. And we need to find ways of aligning those interests together. One of the great examples of this is Barings Bank, where Nick Leeson, through a bunch of poorly orchestrated trades, was trying to hide up some previous losses and ended up driving the bank out of business by losing 832 million pounds, which is roughly 1.2 billion then. In today's dollars, about 1.89 billion dollars. And the worst is, there wasn't another one that was even worse later on in 2009, but this was the worst disaster for a bank, catastrophe for a bank to happen. And what he had simply been doing, again, is lying to his superiors about trades he was making that were very, very risky bets. He was trading in derivatives, mostly strips, we call interest rate strips, and he lost the bank that kind of money. So how do you align that? He's going to deal with a couple of things. First one, we want to understand information. We always talk about information and incentives. So who's making the decision and what information do they have? You want to make sure that people in decision-making positions have the right information. And then you also want to make sure they have the right incentives to get it right. So we think of an example is a McDonald's. So McDonald's decides they want to expand their operations somewhere. They can do one of two things. They can open up their own store and hire a manager to run it, or they can franchise. And the reason you want to franchise is to solve an information problem. People who have local knowledge know where that franchise is best suited. People working in the store have a better knowledge or better information about things that need to change and what they can sell there. So having that local knowledge is important. And also the incentives. If you pay somebody $50,000 a year, regardless of what happens, they have an incentive to shirk. If you make them a part owner of a company, then they have an incentive to make sure it works. If you make them a residual claimant as well as someone who suffers losses if things go bad, then they have an even better incentive to make sure that the franchise is functioning well. So this is how many companies overcome these principal agent problems. Through franchising, I give people the right incentives and they have the right information to make sure the operation works as best as it can. Another one we look at is a real estate agent. This was one that's been looked at by in the book for economics, where real estate agents tended to sell homes that were not theirs at a lower price than what they would sell their own home of similar value and situation. And if you think of what happens, the information problem, at what price should it sell? How long am I willing to sit on it? The incentive problem, what price do you want to take? Do they have an incentive to get the highest price for me? So we can take a look at this by looking at one example. Let's say we have my house listed for $300,000. The first offer comes in at $280,000. So the difference is going to be $1,200 in commission. So the commission for it's a $20,000 difference in the sales price. At a 6% commission at $300,000, the agent's going to get $18,000. Remember, the agent doesn't keep all of this. The agent splits that $18,000 with the seller's agent and the buyer's agent. Then each of those agents have to share it 50-50 with their own broker. So an agent will only keep about 25% of this. So 6% commission is $18,000 on the $300,000 sale. If it sells for $280,000, then the commission is going to be $16,800. The difference is $1,200. What I get to keep out of this, if it sells for $300,000, I walk away with $282,000 minus other taxes or transfers that might be included. And if it sells for $280,000, it's $263,200 or an $18,800 difference. That's a big difference for someone to accept, to take that lower price. I'm going to lose $18,800 if I accept that $280,000 offer. What the agent stands to lose is only $300. If the house sells for $300,000, the agent for the seller gets $4,500. If it sells for $280,000, the agent gets $4,200. So the agent only suffers a $300 loss by accepting that $280,000 offer. The seller loses $18,800 by accepting that $280,000 offer. Maybe the incentives of the agent and the principal are not aligned. One thing you might do is offer a certain sales commission and then a little bonus for every $10,000 more above some baseline price. So employees with decision-making authority must have the necessary information to make the right decisions. And this could be local information. This could be more global information. Keeping that in mind, we want to make sure that the information is in the hands of the person who has the best opportunity to use that to the benefit of the principal. And the incentives of the employees must also be aligned. So when we look at bad outcomes, they tend to be due to poor information. Somebody without the proper information was making a decision, they made a bad choice, and they ended up with a bad outcome. Poor incentives. Nick Leeson is an example of that. Didn't have the right incentive to get it right. A lot of these traders, when you look at the financial crisis, you look at poor information, you look at poor incentives. A lot of the traders dealing in derivatives were really complex derivatives. They didn't quite know what they were dealing with. The other thing is they were looking for some quick short-term gains. And then oftentimes it's bad luck. Sometimes you don't have any control over something that happens, and so therefore the bad luck is going to happen. You could look at weather as a bad luck. You could look at some political catastrophe as bad luck. One thing to, again, think of Nick Leeson's problem. His problems began when he was making trades based on in Japan, and what he found is right after a hurricane, he was expecting that he did what's called a straddle, and basically putting money in overnight that not much would change with the Nikkei stock exchange. However, a huge earthquake caused a major decline in the stock exchange, and he lost a lot of money, and that's what precipitated his constant movement to try to recoup that through some other bad choices he was making. So sometimes bad luck plays into it. You can take care of that by hedging, but the other two is what we really want to look at. So how do you remedy potential bad outcomes? First off, you want to make sure that the agent has better information. Put the people with best information in the decision-making role, or have them as part of that decision-making role. You might want to monitor agents. You also want to create incentives for the agents to act in the best interests of the principal. And again, to ameliorate the bad luck, you want to diversify your hedge. Those are the only ways you can do that. So let's look at monitoring agents. Manager monitors an employee, measures what they do, sees what they do. One of the things with Nick Leeson is he was verifying his own trades rather than having them double checked by a supervisor. Somebody should have been going over his trades to make sure that they were legitimate and they were not going against the interests of the bank. Having one person make those trades, and he was able to set up a separate account to hide all the losses for at least for a little while. Had he been monitored, somebody would have caught on much sooner. You see this with managers overlooking, overseeing somebody, making sure they're doing right for the interests of the company. Monitoring, however, is costly. To be constantly monitoring somebody or watching what they do puts a manager's time doing that as opposed to making other decision-making responsibilities, so it can be a costly venture. But it may be becoming less so due to technology. Now that we have the internet, we can monitor what our employees are doing, see how their trades are going, we can measure their output. You get a better idea from this. Matter of fact, Tyler Cowen is arguing that average is over, in the sense that our ability to measure productivity has become much greater, that those with what he calls zero marginal product are being priced out of the market or losing their jobs. And so it might be easier with new technology. But then again, the question is, or is it? One study shows that employees spend 1 to 1.5 hours a day cyber loafing, surfing the web, watching videos, playing on Facebook. Another one looked at purchases made online. The majority of the purchases made online were made during work hours. So people are obviously using this technology to their advantage to actually shirk even more. Second thing we can look at is incentive pay. Align the interests of the principal by compensating them for the work they do. Stock options are one example. And it may be good for senior managers, but probably not good for rank and file employees, which we'll see in just a minute. One of the things you want to look at is with that one, if you do it for somebody who has control over the business itself, senior managers, a CEO, they have an incentive to make sure that everybody below them is working to the advantage of the company, to the principal. If you do it with rank and file employees, there's always the free riding principle. My contribution really brings in a little bit less, and I don't get to internalize all the benefits of my contribution. Therefore, I'm going to shirk and not contribute, even though I am getting some sort of a stock option. It may not be in my interest. In other words, the value of the stock is not really going to decrease because I don't put in a lot of effort, and the lot of effort I do put in is going to be shared by a lot of other people. Therefore, I don't put a lot of effort. A lot of employees feel that way, and stock options are not that great. Now, they work pretty well for senior managers. Many companies use these. Year-end bonuses. You can do a management by objective and offer a year-end bonus to companies based on performance. Other performance incentives, you look at piece rate pay, for example. Pay employees a certain amount for what they contribute. And again, this has to be based on something measurable. We'll take a look at that. The other one is commission. We see this oftentimes with salespeople. They're paid on commission. Therefore, they have an incentive to serve the interests of the principal because their compensation is based on that commission. Some of the problems with stock options, it may induce short-term thinking. There is a book called Fixing the Game, which looks at exactly this, and the argument is because CEOs are so obsessed with meeting quarterly estimates, stock estimates, that they take a short-term view and not a longer-term view. One study out of Duke found that many CEOs were unwilling to take a risk or invest in something with a positive net present value because it might adversely affect the short-term stock price. So that might be an issue with the stock option. You want to make sure that stock options have the principal vested in the long term. So some do stock options that are exercised over time, so the CEO has an incentive to make sure that it's a long-run interest of the company they're looking after. Sometimes IRS rules can make it less profitable. The way you've got to exercise your stock option to value the actual profit from it can make it not worthwhile. Again, it's not always best for production workers because of the free loading principle. So you think of something like if I put high effort costs me more than low effort. If I put high effort, I stand to gain $200. However, if I do low effort, I'm going to get the benefit of everybody else's high effort, but I'm not going to incur the cost of my high effort because I'm going to be exercising low effort. Therefore, I gain $494.50. Therefore, I'm going to exercise low effort. Performance incentives are another way of aligning the interest of the principal with the owners. Oftentimes, this is used for mid-level managers, and we can also do it with production workers as well. You want to make sure, though, that performance incentives are tied to quantifiable and achievable goals. There has to be something we can measure and something they can achieve. You don't want it to be something that's a very subjective decision. Then it becomes a personality conflict, and you want to make sure it's achievable, because if it's not achievable, it doesn't increase the motivation of the employee. Employees must have support of the company. You can't say, here's what you have to do, but we're not going to support you getting there. You want to make sure the employees are supported with the company. And the employee also needs regular feedback about their performance and how they can continue achieving their goals in order to make them have the incentive, create the incentive for them to excel and perform well. Commission is another one, but there's a risk adjustment to this one. Commissions, you tend to pay more because the employee takes on the risk of events happening outside of their control. If you had a car salesman during a huge snowstorm, a 2-foot snowstorm, where the dealership really wasn't operational for a week, that's the sales commission is of course going to be down because no sales are happening. So you put that on the employee by doing so. So you'd have to have some risk adjustment to that commission. And you want to make sure that the commission is aligned with the objectives of the principal. So a car salesman who's paid commission on sales doesn't have much concern about the actual profitability of any sale. Therefore, you want to make sure that they either are paid on the profit of the car or they're paid on the sale of the car, but then every sale they have to transact has to be monitored by someone else to make sure that they're not selling at a loss simply to make a sale, much like the real estate agent example we talked about before. You also want to make sure that the objective is to maximize profit over the long run for the company, not the short run. Must be suited again for salespeople that go after the high-hanging fruit as much as the low-hanging fruit. If you pay a 10% commission on all sales, well, some sales are very easy to make, some are very difficult to make. I might not want to make those more difficult sales. So one thing you might do, many companies might just say, again, 10% of all sales, or they may do something like 10% of all sales up to $1 million and then 5% after that. A system like that is really just encouraging employees to go after the low-hanging fruit and not even try to get the harder, more difficult sales. Something with 8% for the first $1 million, 12 to 15% for any sale after that $1 million. Encourage them to take the low-hanging and the high-hanging fruit, and try to get all even the more difficult sales that are more time-consuming and may be more difficult to obtain. One last one we want to look at is called the efficiency wage. There's some controversy over this one, but it's an important one to look at. And this simply says pay your employee more than their opportunity cost, and they will put in more effort. They're going to work harder because the cost of losing their job is a 10% decrease in their salary, assuming it's a 10% efficiency wage. And therefore, if you pay them this higher wage, the cost of losing that job is so great, they put a lot of effort in to make sure they don't get fired, they don't get terminated. And that's one way of aligning the interests of the employee with that of the firm. And this was made famous by Henry Ford's $5 a day wage. It's often argued that he did it out of empathy for his workers, but he really did it because it was so costly to keep meeting the high turnover. When he was paying $250 a day, he had a lot of turnover, training costs were very high, worker productivity was pretty low. By paying $5 a day, which was more than anybody else was paying, workers were really, really diligent, worked very hard, output increased, and productivity increased because of this. This is it for our principal agent problem, and that, of course, is saying the end in Japanese.